Okay, welcome back. I'm continuing on with some mini lectures about topics related to investing based on the survey in my IME 4030 class. I've already created the uh, talk about stocks, bonds, mutual funds because even though it was second on the list, it really needs to be the prerequisite to talk about some of these other ones. So feel free to go back and watch that. I'm re-recording my original talk about 401s, IRAs, and TSAs for several reasons. One was the quality of the sound, but a few other things I wanted to kind of polish it up. So what are we talking about here? We're basically talking about tax-deferred savings plans. And this has to do with retirement. And I need to give a little background and talk about retirement plans or pensions. What are you going to do when you retire? Now, uh, maybe you're not interested in talking about retirement because you're young, it's so far away. Uh, to you, this is science fiction. But I'm not just talking about retirement. What I'm talking about is you having the ability somewhere in the midlife or beyond uh, to be financially independent to where you could either go do whatever you want to do, that could be retire, or you might be in a position where you're working for somebody and you are not happy there and you want to do something else, but you may not be able to afford it. You're stuck. But if you have a good solid 401k plan going, you have options. So this isn't just talking about retirement. This is talking about you having security and having options and being able to do what you want to do. So with that, let me point out that historically, people have depended on their own savings, if they had any, um, a little bit of money from Social Security to retire on, along with what we would call a fixed benefit retirement plan, where you worked for a company and you put in 5% or so of your salary every month, every pay period, and then they would build up along with their own contributions in a retirement fund, and you would get a certain amount of money, fixed amount, based on how many years you worked for the company, your age, and what your final salary was. So a typical plan might be a fixed retirement plan would be 2% of your final salary for every year that you worked. And so let's say you worked for a company for 30 years and we use this 2% rule, then you would get 60% of your final salary as your retirement amount. And you may adjust it for what would be called spousal or survival uh, support, where you might take a hit on this, like take take off 25% um, of this, so that if you were to die before your spouse would continue to get um, your retirement. So you could maybe knock this down to 45% um, if they're going to take 25% of it, 25% of the 60% for spousal. And then this is your fixed benefit. And then hopefully you've got your house paid for, your expenses are down, you've got some other money, maybe you've got Social Security, uh, and then that's your retirement. So that's a fixed benefit retirement plan. But what happened was the government realized that Social Security wasn't enough to retire on, and most people weren't saving. So they said, what could we do to help them that wouldn't cost the government too much? And so they came up with tax deferred savings plans, like the original one was the IRA. And the idea was that you could save a certain amount of money every year that would be tax deferred, meaning that you didn't have to pay taxes on that money, um, or uh, or the interest on it until after you retired. And so uh, that evolved into the 401k, where instead of you doing this on your own, you could do it through your company. And a 403b is the same thing, but for educational institutions. Like this would be for teachers, for example. So let's look at the 401k. So that meant that you could, say, put in 10% of your salary into a 401k plan, and that meant that 10% of your salary, I'm going to use a $70,000 example, 10% of 70,000 is 7,000, and then this would be subtracted from your taxable income for the year. It would not be reported by your employer. So that means you'd only pay taxes on 63,000. Well, that would save you, if you're in the 20% marginal tax bracket, that would save you 20% of $7,000, or $1,400 savings in taxes. That's money that is now inside your 401k plan, growing and compounding for many years. All right. So that's nice. You're getting that money instead of paying it in taxes. And the idea being that if people did this for 40 years or whatever, they would be able to save up toward their retirement. So what happened was, with the 401k, companies came up with the fixed contribution retirement plan instead of the fixed benefit plan. Without going into detail, fixed benefit plans were costing companies a lot of money and a lot of headaches. And also people were running into trouble if they wanted to leave a company. What would happen to their fixed retirement plan at that company? In many cases, you would lose it. Um, and so with a 401k, that money goes with you as you move from job to job. And the company puts their match in and doesn't have to worry about some big retirement plan. So let's take a look at what this would mean. And so I've got some numbers for an example. Bear with me here. So let's look at what would be, let's say, your savings here. This is your savings percent. This is the company match here. The employer, I'll just put EMPL, employer. And then this would be the rate of return you're getting on your money. I'm in this column. And then this is how much you would have after 30 years and how much you would have after 40 years. So let's say you saved 10%. You graduate from college, let's say you're an engineer, you get a $70,000 a year salary. Just save that 10%. You won't miss it if you start out doing it. Let's say there's no employee match, just for illustration purposes. And let's say you're going to get a 7% return. Well, where does that 7% come from? That's for purposes of this illustration, that's the that's the return on your investment adjusted for inflation for a market index fund, which is something anybody could get. And so um, we'll use that 30%. And so you would have $714,000 at the end of 30 years, and you'd have 1,502,000 at the end of 40 years. All right. Now, this is based on you not having any raises or promotions or cost of living index, improvements for that period of time. So let's make this a little more realistic. Let's suppose we're still looking at 10% with no employee contribution, but you're getting a 3% cost of living increase every year. That would be for everything. It's very conservative. And now instead, and it's still at 7%, but now we're looking at 988,000 after 30 years, and we're looking at 2 million, see, 2,219,000. Apologize for the lousy writing. All right, now that is if we adjust it for inflation. But now let's add the employee match. Let's say your employer matches half of what you put in up to 10%. So you can put in a maximum of 10% and they'll match half of it. We still have a 7% interest rate. And so now we have 1,473,000 at the end of 30 years, and that's 3,313,000 at the end of 40 years. Now the idea is that you would have this money in there, and when at some point in time when you retire or whatever, you could then live off of the rate of return on your investments here. And so this money's invested and it's making money, and you could live off of it. And so that's the idea. So what if, so here's what happened. Here's what I want to talk about. On LinkedIn one time, this person started talking about that they were going to, it was a young person, and he was going to pull all the money out of his 401k to buy a house. And his argument was that if he didn't do that, he would never have a house. He never thought he would ever retire. He was very pessimistic about the future, claiming people in his age group would never be able to retire and accumulate, and they would always be stuck with working. And so an argument, not argument, but discussion ensued, and there were both sides being argued. A lot of people agreeing with him, yeah, 401k, take the money out, buy a house. That's the best thing you can do. And others saying, no, don't do it. That's wrong. Save your money and save up for a house, but do it with other money. And so let's take a look at that. So let's suppose that you take out at the end of 8 years, you would have 114,000 in there, and let's say you take out that 114,000 to be a 20% down payment on a $500,000 home, and then you start over on saving, but you're still getting the employee match, 7% return. And what would you have then at the end of 30 years? You would have 719,000 at the end of 30 years, and you'd have 1,713,000 at the end of 40 years. This is half of what you would have had for pulling this money out. So you would either have to work another 8 years or live off of less. But what I want to encourage you to do is to go ahead and leave this in so that anytime in your 50s, or say, for example, that you felt like you were, or, in that age range, you would be in a position to where you could still be financially independent. But if you pull this money out after 8 years, you've ruined that option to be as financially independent. Now, let me also point out that what happens with the money that you put into this tax deferred plan. What does this deferred mean? Deferred means that, yes, you're not paying taxes on the money when you earn it, and when it goes in, the taxes are deferred until you take the money out. You can take the money out after age 59 and a half with no penalty, just paying taxes. And if you don't take any money out at 59 and a half and just let it grow and grow, then at age 72, you need to start pulling out a little bit of it so that the government can tax you on it. So the money comes out whenever you pull it out for retirement, and then it's taxed as ordinary income, whatever tax bracket you're in. But typically when people retire, they're in a lower tax bracket than when they're working, and so their taxes aren't as high on that money. But if you pull it out early for a house, there's a couple of options. One is there are a couple of reasons you can pull money out of the 401k if you borrow it from your 401k and pay it back. If you pull money out to buy a house and pay it back into your 401k, the problem is you're losing interest on all the money you borrowed out of it. It's not making interest. Yeah, you may pay it back. But if you don't pay it back, then there's a penalty for pulling it out. Plus you owe taxes on it. So pulling this 114,000 out and not putting it back in, you lose interest and you're penalized. That's just something to consider. See if I left anything out. Well, let me just say that how much you earn in your salary is not the most important thing. Your salary is not what is going to make you wealthy or get you retired. It's not how much you make that matters. It's how much you save, what the investment return you're getting on your investment, on your money is, and how long you save it. It's how much you save, rate of return, and how many years. That will determine your future, not your salary. When you're looking for a job, your total package is your salary, your retirement plan, 401k plan, and other benefits such as educational benefits. Some companies are very generous with it, and some companies don't have educational plans. And if you're going to get a master's degree and it's going to be paid for by the company, that could save you $40,000 over a couple of years. So anyway, that's just kind of the highlights. So let me stop here. But I did want to make a shameless plug, and that is about my book that I've recently published. It's called Letters from Uncle Dave, the 73-year journey to find a missing in action World War II paratrooper. This is my uncle, Staff Sergeant David Rosencrantz. He was missing in action in World War II. And then in 1998, I saw the movie Saving Private Ryan, which was about a missing paratrooper. And I said, gee, I wonder if I could find out what happened to my uncle, because nobody seemed to know. And so this is the story of my 20-year quest to find out what happened to him. And eventually he was found and brought home in 1998. So this is a book all about that. It's very compelling, and you get to know my uncle through the 49 letters that he wrote home. So anyway, that's my shameless plug. And if you go to philrosencrantz.com, you can find out how to order the book or where it's at. Find out more about it. So with that, I'm going to end. I hope this was helpful. And please watch some of these other videos that I'm making.